Twilio generated a record free cash flow of $263 million in its most recently completed quarter, and the management team is using that money to buy back shares. In general, I'm a fan of companies buying back shares responsibly, and especially when I think the shares are undervalued, which I do think with Twilio. I think their shares are undervalued, as I'm going to detail with you here my calculations for why I think their shares are undervalued. So as I highlighted in the introduction, the management team said they generated record free cash flow of $263 million in the most recently completed quarter, and they used most of that capital, $177 million, to buy back shares in the second quarter. Year to date, they've spent over $370 million by the end of Q2, as the figures are not clear from the transcript, but the management team has been buying back shares as they believe their shares are undervalued. And also, the company doesn't require a lot of capital to be reinvested, and so the management team can use the free cash flow to buy back shares and return capital to stockholders. So the management team believes their upcoming quarter, they will generate $1.245 billion to $1.255 billion, or $1.25 billion at the midpoint, which would represent 8.5% organic growth and 10.5% reported growth in the upcoming quarter. Based on their first half performance and Q3 guidance, they raised their full year 2025 revenue growth guidance to about 9.5% at the midpoint, and that was up from 8% at the midpoint previous to the most recent quarterly performance. So the year has gone better than expected for Twilio's management team, and so they're upgrading their expectations for performance. And understandably, they're using some of those benefits to buy back stock because the business is heading in the right direction, and the share price is down year to date in 2025. So management feels this is a great opportunity to use some of that money to lower the shares outstanding, which then increases the earnings per share. Because when you generate net income of a certain amount, and then you reduce the number of shares outstanding, that leaves more profit to be split among fewer shareholders. For the third quarter, they expect non-GAAP income of operations of $215 million, and they're maintaining their full year non-GAAP income from operations range to about $850 million. They're taking the opportunity to make more investments in research and development in response to strong customer demand in voice and other AI offerings. Click the link below to watch the full video.